The strategic objective of tail risk architecture is the installation of a structural airbag for a portfolio, designed to deploy with overwhelming force only when the system faces catastrophic failure. This is not a strategy for improving average annual returns. It is a capital preservation mechanism designed to alter the return distribution. In standard market conditions, this architecture intentionally bleeds capital through insurance premiums. However, during a black swan event, the payoff is designed to be large enough to stop permanent capital destruction and provide immediate liquidity. This allows an investor to acquire panic-priced assets precisely when the rest of the market is forced to sell. This framework is built for a reality governed by fat-tailed power law distributions rather than the Gaussian bell curves assumed by traditional mean variance optimization. While standard models treat 4 or 5 standard deviation events as nearly impossible, empirical evidence from Mandelbrot and subsequent researchers shows these extreme moves occur far more frequently. The architecture thrives during liquidity-driven cascading crises. Think October 2008 or March 2020, where leveraged holders face margin calls and sell every liquid asset simultaneously. Conversely, it is ineffective in grinding bull markets or minor 10% corrections where volatility remains suppressed. Because the insurance premium decays to zero in calm regimes, the strategy requires a disciplined understanding that the hedge is a cost of doing business, not a standalone profit center. By acknowledging that financial markets do not follow a normal distribution, the investor moves from a fragile position to one of structural resilience.
The architectural core of this strategy consists of 2 primary parts, the compounding engine and a defensive anchor. Paradoxically, the presence of a robust tail hedge allows the growth engine to be run more aggressively. Because the hedge absorbs catastrophic losses, an investor can maintain a higher equity weight, often exceeding 90%, than a traditionally diversified portfolio would allow. This contradicts standard risk-off logic, which suggests reducing equity exposure to mitigate risk. Instead, by capping the tail, or the extreme downside, the investor is free to capture more compounding growth during the 95% of the time markets are functioning normally. The defensive anchor typically comprises deep out-of-the-money put options on broad indices sized between 0.5 and 3.3% of total capital. These instruments are selected for their convexity. Unlike bonds, which act as a linear counterweight, these options are non-linearly sensitive to market declines and volatility spikes. As the market drops, the value of these puts does not just rise, it explodes. The math of March 2020 provides a clear example. A portfolio with a 3.33% tail hedge and 96.77% S&P 500 exposure returned 0.4% during a month when the index fell over 12%. This demonstrates that the hedge is not merely a cushion. It is a mathematical offset that can fully neutralize a crash. The goal is to own an instrument that sits dormant until the exact moment of a structural break, at which point it converts a systemic collapse into a source of fresh capital.
The primary failure of conventional diversification lies in the assumption that correlations are stable. In reality, correlations are regime-dependent. Under normal conditions, pairwise equity correlations might hover around 0.30. However, during systemic stress, this number lurches upward. In both the 2008 financial crisis and the 2020 COVID crash, developed market correlations spiked towards 0.80. This happens because of forced liquidation. When margin calls hit, investors sell what they can, not what they want. This leads to the phenomenon where all correlations go to 1, rendering traditional diversification through different sectors or geographies useless, precisely when it is needed most. Static risk models that ignore this behavior typically underestimate true tail risk by 40 to 60%. The mathematical vulnerability of this architecture is the volatility risk premium.
Deep out-of-the-money puts are systematically overpriced relative to their actuarial value. This gap between implied volatility, what you pay, and realized volatility, what actually happens, means that systematic put buying is a negative expected value trade over long horizons if viewed in isolation. Furthermore, attempting to lower this cost through trend following or volatility timing often reintroduces whipsaw risk. The V-shaped recovery of 2020 is the textbook example. The market crashed and recovered so quickly that many active hedgers were forced to sell at the bottom and buy back at higher prices, locking in losses. Therefore, the structural challenge is managing the persistent cost of holding pure, long-dated puts against the risk of more complex, cheaper strategies failing during a rapid reversal.
Successful execution of a tail risk strategy requires the total removal of human discretion. Attempting to time when to buy protection is a losing game because investor emotion typically lags market reality. Instead, a professional framework utilizes a signal-based if-then approach. For instance, monitoring the CBOE SKEW index against the VIX can provide a mechanical signal. When the SKEW rises, indicating institutional demand for tail protection, while the VIX remains low, it suggests that convexity is still relatively cheap despite rising systemic concerns. This allows for a disciplined add to the hedge before premiums are fully repriced. Additionally, laddering expirations across multiple tenors prevents the hedge from expiring just before a crisis begins. From a governance perspective, the focus should be on minimizing fee friction and operational complexity. Black Swan funds often carry high management fees that exacerbate the natural drag of the insurance premium. A more efficient alternative for sophisticated investors is a self-directed options overlay. However, this requires active monitoring of Greeks, the mathematical measures of an option's sensitivity to price and time, and disciplined rolling of positions. The governing principle is to keep the hedge size small enough, typically in the 0.5% to 2% range, so that the cost never compromises the compounding engine. The objective is to maintain a fire escape that is large enough to be functional, but small enough that its maintenance cost is negligible compared to the total value of the building it protects. The final verdict on tail risk architecture rests on a fundamental trade-off. You must accept underperformance during bull markets in exchange for survival during a crash. There is no mathematical shortcut to avoid the insurance premium. It is the structural cost of convexity. Standalone systematic put buying is a negative expected value strategy. Therefore, the rational investor does not ask if the hedge is profitable on its own. Instead, they ask if the hedge changes the portfolio's total outcome distribution enough to justify taking more risk in the growth sleeve. As seen in the performance of specialized firms like Universa, returns in the hedge sleeve are concentrated in a few crisis months, while the rest of the time is characterized by steady, visible costs. This architecture is specifically designed for high-conviction, high-equity investors who cannot afford a permanent impairment of capital, such as multi-generational wealth holders or institutional allocators. It is not for those who cannot tolerate a visible line item of cost year after year with no immediate payout. To use the fire escape analogy, most buildings will never burn down, but for the buildings that do, the fire escape is the only feature that matters. By incorporating this architecture, you are not betting on a crash. You're ensuring that if a crash occurs, your compounding engine survives intact and you are positioned to provide liquidity when the rest of the market is paralyzed by insolvency. You are buying the ability to remain rational when the system becomes irrational.